Yeah, sure. So we've obviously had the situation where in the first half of this year it was mainly non-core measures that were a little bit more contained but driving higher. And then during the second quarter, particularly energy and food prices probably lifted inflation to its likely peak in the second quarter. But what we're seeing right now, energy prices are actually coming down, and we've seen that this week in the August CPI in the US, but food inflation continues to drift higher, and particularly its core inflation in the US is actually surprising to the upside. So there's both kind of services, but also core goods that is not quite moderating as expected right now. I kind of see it as three potential doors. The one door, the most immediate one, is an upfront synchronized recession because of the multitude of shocks that we've just had. That risk remains elevated but is slightly reducing now. The second option, a substantial risk scenario, is that if we don't have a recession right now, there may well be a recession induced by policy measures next year, and that's exactly as you asked about US inflation and effect tightening. The third option is we may be able to skirt a recession this year and next year and engage in that so-called soft landing without a recession. What that, however, would require is core inflation in the US coming down and the labor market cooling sufficiently in the US without substantial upfront policy action.
The challenge with inflation is that it eats into returns, right? Nominal returns. So we tend to focus a lot on nominal returns instead of real returns. And real returns is essentially nominal returns less your inflation. And so if you have high inflation, unfortunately, then it means your real return is going to be lower. However, given that interest rates have also been rising, there is a silver lining, which is that if you're a defined benefit fund, with high interest rates, essentially the present value of your liabilities come down, right? And so you are able to fund your liabilities, you are able to meet the obligations to members, even for a defined contribution fund, right? Because you will be owning some bonds, so and as new bonds get issued at higher rates, you will be able to earn a decent return on those bonds. So there is some silver lining. Yes, of course, you know, some will argue that higher interest rates reduce or slow down economic growth. But I think one does need to fight inflation because, as the Reserve Bank has also said, it tends to hit the hardest your ordinary poor citizens, right? But even with your middle income citizens, so it's a bit of a double whammy, right? So we've got mortgages, and so if interest rates go up, it means our repayments have to go up, but then you also have to deal with inflation, right? So it is a testing period, but importantly also, South Africa has experience with inflation and relatively high interest rates, right? So if you look at what happened during the global financial crisis and after it, where countries like America and Europe were literally sitting at zero interest rates, we haven't experienced that, right? So it is really about navigating the cycles, and I think once you go through every cycle, whether you're an asset manager or a fund, you become better equipped managing some of these shocks.
Right, thanks for the question, Sia. So execution risk refers to the risk of not performing or executing the strategy which you have planned. So it is measured by basically calculating the deviation between your strategic asset allocation and your actual investment portfolio. So in terms of minimizing strategic risk, the governance process involved is that you, as a board of trustees or the asset allocator, would basically oversee the implementation of the investment strategy and basically ensure that the deviation between your actual portfolio and the planned portfolio strategic asset allocation does not differ or exceed the tactical bounds in which have been planned. So it's measured and monitored on a regular basis, and you have regular engagements with the manager to ensure that that risk is managed consistently.